Markets have certainly changed their outlook for the Fed funds rate over the last 3 to 4 months. As we can see in the chart in front of us here, the bold red line is the actual Fed funds rate sitting at 2.4. The blue line, as you can see there, is the uh, progression, if you like, of the 1 year forward Fed funds rate. And so at the end of last year, the market was implying that the Fed funds rate would get to 2.8% in 1 year's time, and that has now fallen back to around about 1.8% in 1 year time. So basically, the market is factoring in two Fed fund rate cuts over the next 12 months, and then a little bit more beyond that. So this is a significant change. So in this video, we're going to have a look at some of the factors that we think you need to consider whether the Fed will actually ease policy over the next 3 to 6 months. Keeping in mind, of course, that markets or the behaviour of the Fed and the behavioural markets will be strongly connected to each other with a whole range of different outcomes possible. So let's just have a look at some of the indicators. So what I just first point out here is we've got the Fed funds rate, and the shaded periods are the easing phases since the early 1980s. So let's have a look at some of the macro factors that have occurred over previous easing. So if we just look first at the unemployment rate, and we're going to look at the unemployment rate relative to NAIRU. So as a measure of the business cycle phase, I suppose, you can see here, this is unemployment rate relative to NAIRU, so falling through NAIRU and continuing to decline. And so that's where we're at the moment, with the economy arguably in late cycle, if you believe this. Unemployment rate down at 3.6, about 1% below what has been estimated to be NAIRU, although that is itself is under question. But what we have found in the past is that that has typically started to roll over in the months and quarters prior to the beginning of the easing cycle. Certainly certainly back also in the late 90s. Margin, just a slight uptick in the 95-96 period, and a very, very modest change leading up to the 98 rate cut. So it doesn't seem to be in place. This fact there's been no deterioration in unemployment relative to NAIRU. What about initial claims? And we can look at that as a daily series, which we'll do. And once again, typically you've seen unemployment claims trough and be rising for some time. Back here, certainly in 2000s, late 80s, early 80s, 95, 96. Although in the 1998 easing cycle, you didn't get much of a move at all in initial claims. So that has some similarities to the current episode, where initial claims are continuing to remain very low. What else can we look at? We can look at, say, the ISM, and if we just get the ISM up, look at that on a monthly basis. And what you've also seen during previous easing cycles, the ISM has typically fallen through 50 on each of those occasions, even in the 96 and also the 98 easing cycles, and definitely in those previous ones. So once again, that condition is not being met at the moment, although the ISM has declined a fair way, but it's still not at that level that has been consistent or associated with easings in the past. If we look at inflation, we would clearly come to the view that inflation is well behaved, very low in the previous easing cycles. Inflation's either been declining or been below the 2% level, or rolling over from a higher level. And I suppose you'd have to say that the conditions on the inflation front are consistent with easing. So by and large, some of these sort of big picture signals are not really in place at this point for an easing from the Fed. Yet when we look at what's happening in the very short part of the yield curve, here I'm looking at the 2-year minus the Fed funds rate, and it went inverse. We can see here the 2 years of the Fed funds rate went inverse in March. That's where you'll see, Fed funds rate expectations being embedded, and that went, as I said, inverse in March, and that has typically occurred at least 6 months prior, 6 to 9 months prior to the beginning of easing cycles in the past, if we go back and look at these previous occasions. So that would suggest, if this was any guide, that would suggest that, well, if there was to be an easing based on this this move into negative territory, would suggest somewhere out around about August, September might be the timing of a Fed cut. So could markets actually wait that long? That is what we'll have a look at right now. Some observers believe that we should compare the current situation to the late 1990s or 1998 easing cycle in particular. So what might that comparison be? Well, if we look at the growth rate of the domestic economy in and around the 98 easing cycle, you can see there real final sales and is the red line, and real disposable income growth is very strong, up at 4 or 5%. In the current episode, not nearly as strong as that, but certainly strong in comparison to the past 10 years, with growth around about 2.5%, 3%. So it seems the domestic economy, as measured by final sales, employment, income growth, is pretty solid and not really that consistent with an easing. Yet, as we saw in 98, there was an easing. And that really reflected what was going on both externally and also in financial markets around the time of LTCM. So if we look at export orders, we can see that there was a very sharp deterioration in the external environment for the US, with the export ISM coming down from 54 to about 44. The worst outcome really outside of the financial crisis, and you can see here the current situation also deterioration, possibly reflecting the escalating trade war, which is certainly putting a dampener on some variables at the moment. So yes, the external situation has deteriorated. What about the financial conditions, or liquidity more precisely? Well, if we go back to, I'll look at the Chicago Fed National Activity Index, or National Financial Conditions Index, I should say. In 98, you can see how that spiked up. So that's a deterioration. It hasn't really done that at this point. If we break it down into some of the individual components, the credit sub-index had deteriorated also. The leverage index had deteriorated quite significantly during that period, leading all the way to 2000. And the risk index also deteriorated. And if I look more specifically at high yield spreads, you can see that they also had deteriorated quite a bit in that period. So there might be some similarities with 98 in terms of a reasonable domestic growth backdrop, but as yet the comparisons with some of the liquidity conditions and financial conditions of 98 are really not quite there, not quite visible just at this point. And we feel that the Fed would probably either want to see a deterioration in some of these economic variables, or perhaps a deterioration in some of these financial conditions before it actually implements the cuts that the market seems to so desperately want to price in. Thank you.